Welcome back in, everybody. I'm actually really excited about this video. We're going to dive into an individual stock that I've been keeping an eye on. I personally, just by scratching the surface, think this could be tremendously undervalued or underappreciated. It's in an interesting sector. It's consumer discretion, and it's in the gambling side of consumer discretion. So we're going to dive into today MGM. Now, some people may not agree with the whole gambling side, but I like the diversification of this business. They're really getting more integrated on the technology of the consumer, but also they have hotels, restaurants, and casinos. So if you believe we're going into a soft landing, or you believe that the economy is going to remain resilient going into 2025, this may be the stock for you. Me personally, I actually think we are possibly heading into a recession, but I still like this stock because if it gets any cheaper and we do go into recession and it completely sells off, really like the setup to buy this extremely cheap and own it long term. If the price analysis comes out, once again, we're going to take our bias out of it. We're just going to dive into the numbers. We're not going to assume anything. We're just going to let the math equate to where we look at price. So hopefully you guys like this type of analysis. Make sure you like and subscribe, and welcome into Compounding Capital. First thing I want to do is just take a look at the history of this chart. This stock has been kind of all over the place, as we can see here. Had a massive spike in the 2007 financial crisis, came crashing down, and then had a nice steady increase here of over $33 a share in 2018. We obviously had the pandemic, sold off once again to nearly $8 a share, now spiked back up to over $45 a share, and now here we are again, sitting around $36 to about $38 a share, currently sitting at $38 a share. This is a company that does $17 billion in revenue, just a little over $11 billion market cap, and is trading at a forward PE at 16, nearly 17 times. Now, the thing I want to point out is in 2019, this was a company doing over $12 billion in revenue, was still growing their revenue, obviously had that huge collapse during COVID, and then steadily grew their revenue back up to over $17 billion. Now, what I want to point out is the stock was basically trading at the same price in 2019 as it is trading in the trailing 12 months, but it's doing a lot more in revenue. When we bring it down to an EPS standpoint, as you can see here, earnings per share is always going to follow stock price. So earnings per share was $3.90, went negative during COVID, jumped back up to $2.44, and has been sitting right around $3 a share. We take a look at sentiment around the stock. We have a low of $44, a high of $63. Going forward, they're projected to do right around 1 to 2% revenue growth and just a little over $2 a share consistently. Now, one area they need to work on is obviously going to be the return on invested capital. They haven't been deploying capital well, and that's definitely a negative effect on the company. Not only does MGM own a ton of casinos and hotels such as Aria Resorts, obviously MGM, Bellagio, Borgata, but buying into this company, you're also getting exposure to a lot of restaurants as well. Very consumer discretion, as I stated earlier. This is also international company having exposure to China, and they are investing for expansion in Asia. Not only are they expanding in Asia, but they do have that partnership with the technology platform of BetMGM, a handheld online sports betting. Few things I like about what the company's doing. MGM China declared a special dividend. They repurchased over $300 million of shares in the third quarter, approximately $1.3 billion year to date, and they're getting accelerated growth on BetMGM with record third quarter revenue of nearly a 20% increase. When we take it down to a diluted earnings per share, we can see that they are growing their earnings per share. Now, they did take a few hits here, so when we bring it down to adjusted earnings per share, you're going to see a loss here. Once again, loss of debt and equity investment was negative 18 cents impact, and change in the fair value of foreign currency contracts was negative 29 cents. So they took two massive hits here, which made earnings look a little bit rougher than it is. Now, the segments I want to point out here is casino revenue did dip in the Las Vegas Strip by 13%, but with that being said, they were able to make a lot of it up with the room revenue. So once again, this is the Las Vegas Strip, and room revenue was up 7%. Occupancy rates at 94%, which is extremely strong when we're looking at hotel stays. So the nice thing about this business is, yes, casinos underperformed, but because of the well diversification of the hotels, restaurants, and everything else, we see that they were able to pick it up here on the hotel stays. Now we take a look at MGM China, and take a look at this, 12% growth in casino revenue in MGM China. But because we're digging into the nitty gritty, what do we see here? We see a big bump in expenses here. That's going to really ruin what we saw earlier on EPS. So expenses could be skyrocketing here. That's something we might want to dig a little bit more into. Is this because of expansion, or is this because of labor costs going up? So we want to know a little bit more of why this is exploding. Now, the one thing I do want to point out is the capital expenditures, the amount of debt that a company like this carries with the hotels, the restaurants. You're looking at $31.5 billion of total debt that the company has and a cash position of right around $2.9 billion. So when we look at ratings, Schwab actually gives it a D for an underperformance. Morningstar gives it a 4-star rating. Morningstar believes this is closer to a $50 stock. So when we look at Morningstar's overview on the company here, pretty interesting. And they highlight something that I'm very excited about for the company more longer term here. The company's leading omni-channel presence in the US should aid in a highly competitive sports betting and iGaming market growth. And that's what I see the value in this company when I look at the valuation. Not only do you have a diversified business model with restaurants, hotels, and live casino action, but you have that iGaming that should grow revenues, should grow margins, and really sustain a nice business model long term. They also expect the company to have a Japanese integrated resort in 2030, accounting for an estimated 3% of total EBITDA growth. Macau is obviously the headwind, and the Chinese government is obviously the headwind here. And when we look at valuation, you guys can see that it is trading for a little bit of a discount compared to its peers, trading at 11, 12 times earnings. So with all that being said, I get 2 price targets. From a free cash flow standpoint, I get $43. From a multiple to EBITDA, I get $25, $26. So we take the $25.50, add the $43, divide it by 2, and we get an ideal stock price sitting right around $34.25. Now, ideally, I would like to get this in the high 20s, low 30s. And I do think you will have that opportunity to even get it cheaper than that if we do go into a recession. So a lot of things I like about it. Let's talk about the negatives really quick. Negatives is low return on invested capital, high debt, and very, very reliant on consumer discretion. Positive is that it is well diversified, exposure to many different markets, has restaurants, hotels, and now iGaming. And the iGaming is the wild card where I think you can get margin explosion. And I also think you can get accelerated revenue growth with the iGaming, along with the fact that they're investing more into the Asian markets here, where there's obviously a strong appetite as we saw double-digit growth. So a lot of things I like about it. I think it's a well-diversified consumer discretion area that I personally would like to own, especially in a strong economic backdrop. So as always, guys, hopefully you enjoyed my dive in. Once again, I'm going to give it a price target between $28 to about $33 a share, just slightly below where my average came in. And we will see you all in the next one.